This is the Gold Newsletter Podcast, your home for investment, economics, and geopolitics. For our publications and archives, go to goldnewsletter.com. Folks, welcome to the Gold Newsletter Podcast. We are privileged to have Brian London back co-hosting with me today. Brian, I hear you got a storm going on over in New Orleans.
Yeah, we may have some background noise here, and if I'm off the podcast for a little bit, I might be under my desk, but the microphone will reach, so it should be fine.
With Brian returning, I'm glad to maybe direct the podcast back to our theme, which is investment, and particularly in gold. And we have a specialist on that topic today, particularly in energy investing. He is the founder and president of the Outsider Club, which I really like your website. I will admit I signed up for your email updates just today. An investment director of the Wall Street Underground and Early Advantage. And his name is Nick Hodge, and he is also the author of Energy Investing for Dummies. So, Nick, welcome to the show.
Well, thanks for thinking highly enough of me to have me on, and thanks a lot for signing up for the newsletter.
No, I look forward to it. And just before we started recording, we mentioned that one of the topics that you've been writing about, which is the development or growth of this medical marijuana and recreational marijuana industry or investment in this growth area. So do you want to touch upon why this is gathering your interest?
Sure. I think right off the bat, it's a quasi-contrarian space, right? And that's what Outsider Club lends itself to primarily, hence the name Outsider in the title. We like things that aren't mainstream, and marijuana certainly isn't mainstream yet. It's not even legal federally in the United States. So I think it's attractive from a contrarian perspective. It's also attractive as a ground floor investment opportunity, similar to the end of Prohibition. I know that comparison has been made before, but really you have an industry here that's been bound up, that's been illegal for decades, and you have pent-up demand in the form of people that have been using illegally, and also a lot of research going on in the medical side of things, as well as other health things like lotions and oils. So I just think it's a really big industry. It's really early, and while some of the valuations may seem a little crazy at the moment, I just think that there's a lot of investment opportunity on the horizon in the cannabis space.
I agree that there is pent-up demand and opportunity there. And one of the weird elements of dealing with both marijuana and hemp is actually illegal to grow and trade it in the United States, is that therefore people just buy it from Canada. And so that there's a missed opportunity there. And in your article, Create Your Own Cannabis ETF, you mentioned that the very first ETF is actually a Canadian one.
That's right. It's actually just in the past couple of weeks, there's been approval from the TSX exchange to get a medical marijuana ETF listed. And there's also been a company here in the U.S. that's applied with the Securities and Exchange Commission to have an ETF in the States as well. And I believe there's also one mutual fund. So I think that speaks also just to how early it is for retail investors who really have the advantage at this point because they can buy so far ahead of these institutional names. I mean, you don't even have, many indexes or ETFs or certainly institutional funds that are out there buying marijuana stocks yet. And so it's still possible to drink upstream from the herd. You mentioned Canada, and Canada just announced this week that the week of April 10th, they're going to announce, nationwide legalization on the recreational side. So, just catalyst after catalyst in this space. It's really exciting. And, from my seat as a newsletter publisher, it's easy to see that there's plenty of retail demand for these cannabis and marijuana equities.
Nick, it's interesting how Canada plays in all of this because, as you know, about 3 or 4 years ago, there was a big boom in Canadian marijuana stocks, and everybody was rushing in to get into them, and they were just sprouting up like, mushrooms after a rainstorm. And then it faded away a bit, and it just seemed like that was a real short-term boom, and the opportunity came and went. But now I guess we're having another wave upward. It just seems like these companies are sprouting up again and opportunities all over the place. And I guess that's being fueled a bit by the impetus from the U.S. market, the emerging U.S. market. So, I'd like to get your comments on that, how the U.S. market plays into it. But also, have you gotten much blowback from your readers for covering this sector? I know that for a lot of people, they probably find it offensive to invest in. But have you gotten any reaction from your readers that's been really, or a significant negative reaction from your readers?
I'll tell you what, Brian, it's definitely mixed. As you know, the newsletter crowd can sometimes be an older and more conservative crowd, and there has been a cadre of readers who have voiced their opinion that they don't want to invest in cannabis stocks. They don't agree philosophically or ethically with it, and they're not going to partake in that market. And you know what? That's fine. We're receptive to what we hear from our readers. And so what we did here at Outsider Club is we created a specialized publication just for marijuana stocks called the Marijuana Manifesto. And so whereas we were covering those stocks inside of other newsletters before. This way we've broken it out into its own publication, and so you can subscribe to that if you'd like to partake in the marijuana sector and have information delivered to you about it. And if not, now we've parsed it out of our regular newsletters, so that way you don't have to read about it if you don't want to. But I would say on balance, much more interest in the sector than disinterest, although we have had some letters, people that don't want to invest in it for sure. And, to your question about the U.S. market, I think that, there's a bit clearer framework in Canada when it comes to both medical and now soon to be recreational. And so I think the appetite for equities there is a bit larger, even from U.S. investors, because it's viewed as a little bit safer, right? It's not illegal federally. And so in the U.S., I think you're starting to see a market that's maturing. You've had some U.S. companies that are listing in Canada that are taking advantage of a TSXV listing. And you also just have an industry that's maturing. So whereas, 3, 4, 5 years ago, it was a garage tinkerer business, right? It was people growing clandestinely. Now these people are coming out into the open as it becomes more accepted, and you have the business types, the MBAs coming in and making lovely marriages in some respects. So I think that's one thing to look out for, is these guys that have been doing it for 10 or 15 years that are now partnering with legitimate, financial and capital markets people to create a good investment. As opposed to some companies who were, lithium or cobalt companies 18 months ago, and now are all of a sudden, Vancouver marijuana companies. I think that's an important distinction to make.
What about the legal pushback? Because my understanding is that these medical marijuana companies, since it's still illegal at the federal level, cannot even open bank accounts, and then they cannot deduct expenses when they go to file their taxes. So, and could this, my sense is this could even get worse, given that Sessions is the new Attorney General of the United States. Yeah,
he's definitely sent a couple of mixed messages. Before he was confirmed as the Attorney General, he had a couple of quotes that maybe would seem a bit softer on medical cannabis. But, since he's been confirmed, he's taking a more hardline stance. I'm no expert on federal legality of cannabis. I'm more on the investment side, but I would say that, a lot of the equities that we've recommended, in fact, I'd say nearly all of them are Canadian listed for that very reason. And I just think it's growing pangs, right? It's only natural. It's only inherent in a ground floor industry to have, murkiness around the legal framework. So, it's scary and it's risky in some respect, but I just think that's indicative of a market that's just starting to get going.
Nick, one of the things that really attracted me to your writings and your letter a few years ago, and really one of the reasons why I started having you become a regular speaker at the New Orleans Investment Conference, was that you seem to be on the leading edge of a lot of these alternative markets and really have just a great grasp of, or gain a quick grasp of these markets. I mean, you cover everything from gold and metals and other resource stocks, alternative energy, lithium, every new trend that comes up, you seem to be on the catching the wave for your readers. And so where do you see, out of all that panoply of resources and sectors that you cover, where do you see the real opportunities right now?
That's an interesting question. It's like picking a favorite child, right? I'm relatively sector agnostic, as you just alluded to. I like things that make money, but I'm also attracted to tangible things, usually things I can hold in my hand. And of all the things that you just listed, I think you might have missed one there, and it's uranium.
Oh yeah.
I think uranium presents a really distinct opportunity for investors right now. Of course, I always think there's opportunity in gold and silver because of the hard money aspect. But uranium and the energy aspect is really interesting right now. It's been in a brutal bear market, since Fukushima in March of 2011, and I've been pounding the table on uranium stocks for 2 years now, and admittedly, I've been a bit early, but I think we finally started to see a turn here. So, if I could just take a step back, what happened was we saw these equities take, in many cases, an 80 to 90% loss across the board, and bigger uranium companies too, like Cameco and Denison. We saw their shares really, really get knocked down. And people were calling for the global demise of nuclear energy, really, after Japan shut down its reactors and Germany said it was going to follow suit. It was, investors viewed the uranium sector as done for. But, flash forward 6 years now from 2011 into 2017, we've had uranium prices bottom out at, their all-time inflation-adjusted lows at $18 in November 2016. They're back on the upswing now, around $24 or $25 a pound. You have more nuclear reactors under construction now than there were before Fukushima. You have China coming on in a big way. In fact, China in Beijing, they just shut down their last functioning coal plant last week. Very indicative of their transition to a cleaner energy economy. You have environmentalists embracing it, whereas before they were vehemently opposed to nuclear energy. They've come to Jesus and realized that they can't combat carbon emissions and nuclear energy at the same time because of uranium's emission-free capabilities and baseload capabilities. And at the same time, the bear market of the past 6 years has had uranium prices so debased that no one has invested in new production and exploration. And so when the utilities come back into the market to buy here as these new nuclear plants are constructed and come online, it's going to be a lot of people rushing towards a small hole to buy uranium. And that's exactly what happened in, the last cycle. It's a cyclical business, as most metals are. And I think we're really starting to see the cycle turn in uranium. I hope that's not too long of an answer, but I'm pretty excited about it.
No, I agree with you. I mean, we laugh the last 2, maybe even 3 years on our mining share panel at the New Orleans conference. We've gone down the row of newsletter writers and analysts, and everybody has agreed that uranium's the next big story. But everybody acknowledges that we've been saying that for the last 2 or 3 years. So when is it going to happen? It's a irrefutable argument, but it doesn't mean that it's imminent. But pushing back on that a little bit, we just had, or recently we had Cameco's contracts with a Japanese utility that were priced at I think $140 a pound. The Japanese claimed force majeure and canceled the contract. So you have that supply coming onto the market. Westinghouse just a couple of days ago declared bankruptcy because of cost overruns at the nuclear plants that they're building. So, there are some headwinds here. Do you think that's something that's going to put a halt to this brief or recent resurgence we've seen in the uranium price, or is it just another sign of a long bottoming process?
It does seem like every time the sector sticks its head up a little bit, it gets batted right back down, and that was certainly the case with the news items you just mentioned. Westinghouse is definitely a black eye on the industry of late, but there was definitely some mismanagement with Westinghouse and Toshiba, putting eggs in the wrong baskets, if you will, over the past couple of years. And the economics of nuclear are sound. The plants are expensive to build, but once they're built, they're really cheap to run, and the uranium is a very small component of the overall cost. So, while in the U.S. it's been a nuclear renaissance that's really hasn't materialized, I think you have to look elsewhere in the world. I mean, literally in Asia and India and Eastern Europe, they're building hundreds of nuclear reactors. And I just think that, going forward, the world is gonna need these. And I don't see any sort of drift from the plans. I mean, they're the only source of clean baseload power, and I think they're going to come online. And I also think it's indicative of a bottoming process, as is the Kazakhstan announcement. So you take the Kazakhstan announcement of a 10% supply reduction from late last year, the Westinghouse announcement, and then the Cameco announcement from a couple of months ago. And I think these things are all indicative of an industry that is certainly writhing. I mean, you know, to be blunt, I mean, the industry has been in the doldrums, but I think that's the time when you want to deploy capital, right?
Yeah, you know, I agree with you. Looking at the supply and demand and flows, it seems like at some point over the next year to 18 months, the utilities have to come back in the market to replace their long-term contracts, and that's going to be a driving factor in the near term. And, you know, I look at uranium as being something that's going to be a 2 to 5 year story. But looking further down the road, the only threat I see to it is, of all things, solar energy. Now that the battery end of the equation, you know, the storage of the energy, so that you have power at night, is really advancing, and costs are coming down. And you have utility scale battery development by Tesla and other companies. And that's having an impact on the resource market. And I know that you're, again, on the cutting edge of that as well. What do you see as far as lithium, cobalt, graphite demand? Any opportunities there?
I think all three, and even manganese, which is the third forgotten, mineral that's required for batteries. Yeah, you know, lithium had a hell of a 2016. I mean, it was probably one of the best performing commodities, and certainly the best performing group of equities. You know, there was Lithium Juniors, one we were involved with. Lithium X, we financed at 15 cents, and it ran all the way to nearly $2.50. So. That has settled down a bit. In fact, you know, over the past couple of months, lithium equities across the board have really pulled back, and it's been cobalt that's come on strong. And who's there at the front of the pack? Of course, Mr. Robert Friedland with his clean tech play in Australia, and now there's a bunch of follow-on companies, and yeah, there's plenty of opportunity there. The world is going to need lots of lithium. The world is going to need lots of cobalt. The problem, as always in the resource market, is, you know, where are the economic deposits, especially as it relates to cobalt, and for investors, where are the pure play deposits? You know, cobalt primarily is produced as a byproduct of silver production. So there's tons of opportunity there. I think you hit the nail on the head with the transition to clean energy production and grid storage and vehicle storage. It's going to be a decades-long transition, and I think that, you know, as investors, you have to look at the market and see who's done quality deals in, you know, the resource sector space before, and particularly in strategic and critical metals, and do as much diligence as you can, and see who's going to come up with a winning project and a winning management team. I think it's exciting times. It
really is. You know, cobalt does seem like it's going to be the next little play that's developing. And I see people who try to disparage the cobalt market say that its production is almost exclusively as a byproduct. So therefore, you can't have there's no impetus for a reduction in supply. But I look at that as a real advantage, because you also can't increase production. And we see the real story is on the demand side of the equation.
That's right. I mean, we got a lot of batteries that are going to need to be produced, whether it's at-home storage for rooftop solar, or grid level storage for utilities, or, you know, the predicted uptake of electric vehicle adoption, and it's that clean aspect of it that I really look at, right? I look at the whole value chain. You talk about demand, and let's look at the value chain of demand. So you have somebody who's got, solar panels on their roof, and they want to store that energy. Or you got someone who's driving a Toyota Prius. At some point, they're going to look at, you know, where are the materials that power this car or that power my home coming from? Just like they didn't want, you know, dirty oil, dirty gasoline coming from coming from the Middle East, they're not going to want cobalt coming from the Congo mined with child labor. I don't think that's a story that's really been picked up yet and that's hit the mainstream. But as someone who likes to look down in my crystal ball and see what's coming down the pike, I think that eventually people are going to say, "Hey, wait a minute. This battery might not be as clean and green as it was built to be," and I think that that's going to be a major catalyst in the adoption of resource supply that has a cleaner bill of health from start to finish. And you're seeing that with Apple, who has said that they're starting to source, better produced, more sustainably produced, more humanely produced input materials for their devices.
You know that I'm involved in the solar market a good bit, and one of the things that I've looked at is solar prices have come down, and solar is the preferred or the economically advantaged source of energy in 14 or 15 states in the United States already. And in the vast majority of the world, actually, which pays typically much higher energy prices than the U.S., but one of the things that I look at as a source of demand for all of this is just energy independence, in that as long as rooftop solar has the ability to get you disconnected from the grid and completely independent, as long as it's affordable, it doesn't have to be the cheapest alternative. And that alone is a very significant source of potential demand. I tasked our scientists at Natcore Technology to find out or try and figure out what would be the minimal level of solar cell efficiency needed to make the average house in North America completely independent and being able to cut off from the grid. And it's right about 20% efficiency, which is right about where commercial cells are right now.
Sure.
So I think that's going to be a big market that we're going to see develop in the very near term.
Oh, it's going to be a giant market, Brian. I live in a neighborhood just north of Baltimore, and I keep a pretty good eye on who's going solar. And it seems every month there's a new house that's getting solar panels, and that's just in some Baltimore suburbs. So, in the Sunshine States, the uptake is going to be even faster. And I guess I'll make a little breaking news here. I've got an offer in on a cabin in Washington State that I might soon be moving to, and I've already started looking into solar as an option out there in the country. So it's a great option. The cost is coming down. It's only going to get cheaper. The efficiencies, as you say, are right where they need to be. The point of grid parity has passed in many places, and solar going forward is going to be obviously mass adopted. Yeah,
now that the battery part of it has been solved. Yeah.
I'm looking at the contents of your book here, Energy Investing for Dummies, and I guess on the flip side of solar is coal, of course. And you have a chapter named "Coal Still the King." Would you still make such a headline for a portion of your book?
Oh, I don't think if I were writing the book today. That book was completed in 2012, 2013, and coal was still the king. On a percent generated basis, it still is, but it's not going to make advances like obviously solar and wind are going to make. I think that we had President Trump just this week say, sign executive actions that pretty much are going to pull us out of the France Accord, the climate accord. And he's saying that really there's people in the industry who are saying that I've read some think pieces from in the past couple of days saying, no way, man, these jobs, they're just not coming back. It's, the cost to the climate, the available alternatives, the reduction in cost and the available alternatives. I think it's spelt to death now for coal as an energy source. Steel is another matter, of course, but energy production is not looking good on the coal side.
Gotcha.
Yeah, the jobs may not be coming back, but at least they're probably not going to go away as quickly now that Trump's in office.
That's a fair point, to be sure.
Well, one of the I have Nick on our energy panel every year in New Orleans too. Like I said, he's a great bench player for my conference because he can cover so many areas. And I know that you do cover the energy market. Nick, what do you see for the future of oil prices, natural gas prices? I mean, it's an amazing thing what the U.S. fracking industry has done in standing up to Saudi Arabia, and taking their blows and being able to respond. And the real key that I don't think other nations understand is we do not have a nationalized oil industry, and it's such a testimony to private enterprise, the rule of law, private ownership of resources in the U.S. and what that can do to create a dynamic market. Whereas other countries are looking to the U.S., well, why don't you cut back on production to elevate prices? And they can't. They literally can't do it because we have a free market here. So do you think that we ever have, given the dynamism of the U.S. energy market and the way that U.S. producers, even these small independent producers, can discover or exploit and develop and produce oil in a flash in response to price signals, are we ever going to see really high oil prices again?
You asked the tough questions, Brian. I think we will see high oil prices again. I think you will see $100 a barrel oil again. I don't think you'll see it for at least a half decade, if not a decade. I think that the underlying economic fundamentals right now simply aren't strong enough to grow demand the way oil demand needs to grow for oil prices to reach those levels. Look, you have news out this week saying that U.S. GDP for the quarter is going to be 1% annualized, 2% total for the year. I just don't think the recovery has been anemic. It's a 1%, 2% recovery. I don't think that sort of growth is enough on the demand side to spur prices to rise that high that fast. On the flip side, you have what you were talking about. The fracking industry has entirely retooled. The IEA, the International Energy Agency, was saying this week that at $50 to $60 a barrel oil, there's a lot of new fracking supply that can come online now because of the advances since the downturn a couple of years ago. And so I think you're in a relative state of equilibrium here, $50, $60 oil for some time to come. But I don't know if you know, but I'm a subscriber to the peak oil theory, and fracking hasn't changed that for me. I still believe it's a finite resource. I still believe that there's no more oil being created, and I do believe that it's going to become scarcer and scarcer, even with the improvement of technology. And so I think in the long term, and I'm still a young gentleman, Brian. I'm only 33 years old, so I think I'm still going to $100 oil.
Yeah, you are a young guy, and if you take care of yourself like I know you do, maybe you will at some point. But I agree, and I think it's way off in the future. But you bring up another point in our closing minutes here. Let's touch on gold, one of my favorite subjects. You brought up the idea of tepid growth. We've had the Trump bump. We've had this whole rationale that the economy is really going to get kickstarted by Trump's tax cuts and infrastructure spending, et cetera. And we've seen that unravel recently a bit and come into doubt. What do you see for gold if the economy recovers, and if not? If we do have a slide back in the economy and the risk of recession and the Fed perhaps returning to easing, I think gold's going to benefit regardless of what happens. But I'd like to get your view on it.
I'm in the gold bull camp right now. I think that this bull market is getting a bit long in the tooth. I think that the Dow Jones Industrial Average has been down 9 of the past 10 days, and that's the worst streak it's ever been on since 2011. I think that it doesn't take much capital coming out of equities at all-time highs and moving into the resource space, particularly the precious metal space, to send those metals and equities much, much higher because they're much smaller markets compared to, obviously, the U.S. equity market. I think that debt levels are rising very, very fast. I think that companies have used cheap interest rates and nearly free money to not reinvest in productivity and new factories and new capital equipment, and instead have bought back their shares, which is propping up the market, in my opinion. And I think that any continued outflows from U.S. equities is going to bolster precious metals prices very, very sharply. You've seen just in the past week a divergence between the gold price and the major equity indices. And they haven't really diverged much in the past year, but you're starting to see that when money flows out of the mainstream market, it is certainly now flowing into the precious metals. And I think, gold sees $1,300 to $1,500 easy over the next, 18 months.
Well, I'd like to hear that.
I should add before we go that Nick is coming to the New Orleans Investment Conference, or at least that's what I understand. And
I'll be there.
Yeah, the 2017 registration is open, and I think the full schedule will be up soon. Do you want to comment on that, Brian?
Not the full schedule, but we're going to announce some big name speakers in the very near future. We're just working to lock them in right now. But it's really going to be a great year. We've got tremendous demand, and as you remember, the hotel sold out last year, so we're trying to get people to sign up as soon as possible so they don't miss out. We're going to have an extraordinary lineup of speakers, but I also think the market environment is going to be absolutely conducive to the type of gains we've seen in past years at the New Orleans conference when the metals have been in a bull market environment.
Excellent, mate. So, Nick, I appreciate your time, and we'll be following your work. Thanks so much.
Thanks for having me. I certainly appreciate it. Thanks, Brian.